Good morning. Thank you for joining me on Capstone Coffee Conversation. My name is Ryan Skogstad. I am with you by myself today, and hopefully Brian Felshaw will be able to join us next month. But today I thought we'd just do a recap of what the year has looked like so far, maybe some things that we're looking at as we begin into 2025, and then also just some year-end things to think about as we have about 3 weeks until the end of the year, and then we close the books on 2024. It goes very fast these days, it feels like, at least for me. So let's kick it off. Before we do, remember, or I'm just going to remind you, if you have any questions that come up as we're talking, please chat into the host. Ayla is back behind the computer today, and Ayla then will feed me any questions after we get done. So please just hit the chat to host on your Zoom, and we'll try to cover those at the end. So just a recap of the year, 2024. It has been an excellent year in the markets. If you, I say this all the time, but if you ask me at this time last year, what was 2024 going to look like? I would be hard pressed to say that we would have a year in stocks that we have had. It has been an excellent year on the heels of 2023, which was also a very good year in stocks. 2022 was the opposite, but 2022 negative for stocks, a horrible year for bonds in 2022, 2023, pretty darn good year for both. And 2024 also has been a really good year as we look just 3 weeks to go. Just to give a recap on some performance type numbers, the S&P 500, just looking at the 500 biggest companies, it's market weighted. So the S&P 500 is really driven by about 7 to 10 of the biggest companies. So it's becoming less of a diversified index. But the S&P 500 is up about in the high 20s for a percent return year to date so far. So it's had an amazing year, again, driven by mostly some of the top 7 or 10 companies. The equal weight index, so now a little bit more of a diversified index where we own the 500 biggest companies, but we own them all equally instead of just being reliant on the top 7 or 10. The equal weight index is up about in the high teens for a return so far this year. So still a really good return, not quite as good as the market cap weighted S&P, but high teens for the equal weight index. Small companies in the country, in the US, up also about in the high teens for a percentage return. So domestic stocks in the US have done extremely well so far this year with just a few weeks to go. International stocks have had an average return for the year so far. So not bad, but definitely not high teens or high 20s. But international stocks are coming in really close to low double digits on the year. They have diverted since the election from US stocks. So US stocks have actually had a nice bounce in the last 1 month after the election. International stocks have had a little bit of pullback in the last month since the election. And we've kind of talked with that through clients, and everybody probably kind of had point at reasons why that could be the case. But international stocks still having about an average year return. The average bond, if you just look at and say, give me one of everything in the bond universe, okay of a year, not great. Low single digit returns as we look at it today for the average bond. Our clients have stayed pretty short in duration on the bond market. We've tried to own more short-term fixed income. That's about mid-single digit returns. So you're looking at the neighborhood of 6-ish, 7, sometimes even 5, but about 6 to 7% return for low duration or short duration fixed income. So bonds a little bit closer to like an average return. Stocks internationally about average, and then US stocks much better than average so far this last year. Reminder, when you're holding bonds, you aren't holding bonds or fixed income for excessive return, right? We aren't expecting bonds to beat stocks on a consistent basis, but we hold bonds for the risk mitigation factor, so provide stability for accounts, right? The goal of our goal is to try and give a predictable, secure type of return on a consistent basis, and that's what bonds and stocks afford us to allow us to do. Again, if you asked at the beginning of this year, stocks could have gone down this year. We can all look back and say, oh, they did great because of this. But when you're looking at it going forward, it's hard to know that this is going to work out the way that it has. So fixed income has done fine, done well, done about average. And it does its part though in helping to make sure that we get a predictable and kind of secure a return. Looking at some alternative type of asset classes, they have done very well. Also, things like gold has had a return about in the high 20s also this year. So much like kind of the S&P 500, gold has rallied for 2024 and returns in the high 20s. And then last, crypto. Crypto has doubled in the last 12 months, almost 12 months approximately. So most of that return has been in the last 1 month. With a new administration, they are looking to be most likely more crypto friendly than the last administration. And so if crypto can continue to become more of an investable asset class, which is what it looks like may happen, then that is poised to do well. And that has doubled this year, but a lot of that return is actually in the last 1 month. For a lot of the year, crypto went sideways, but has done very well this last 1 month. As we look at where things stand today, a little divergent. The S&P 500, which has done very well for the last 2 years, I've given the analogy of a flashing yellow light. Could it have a great 3 years in a row and have another amazing return next year? It's not out of the question. Yes, it could, but it becomes harder. It becomes more of a show me. Valuations of the S&P 500 today are hitting levels that it's only hit a few different times in the last 30 years. So the last time that valuations were this expensive were right after COVID, right? When companies basically were shut down, but were receiving free money from the government. So companies were not making much money, but their stocks did very well. And they stayed somewhat this expensive for a couple of years, and then 2022 saw the big pullback in stocks. And then the other time that stocks have been at this valuation in the last 30 years were the late 90s. In the late 90s, stocks did extremely well for a few years in a row and kind of defied gravity for a while, but then we had the tech bubble, and 2000 stocks came crashing back down. So we are hitting valuations that give us a little pause. We've been here before where valuations have been this high on the S&P 500, and sometimes they stay high for longer than you think, right? The tech bubble didn't end in a month. Stock valuations went up and they stayed pretty high for about 3 or 4 years in the late 90s before the crash, and they stayed high post-COVID basically all through 2020 and 2021 before having the 2022 collapse. So it's not like stocks are going to necessarily, this is not a doomsday where, okay, their valuations are high, therefore they go down tomorrow. That's not necessarily the case. Sometimes stocks can become expensive and stay expensive for longer than you think. Momentum is a real thing. But it does give me the flashing yellow light that you want to be careful and not be over your skis in things that look like the S&P 500, because it's going to get harder for those to have excess returns going forward. On the flip side, stocks can stay cheap for a long time as well, and longer than you think. The financial crisis of 2008, we had stocks that were cheap and they stayed cheap for about 4 years, to end of 7, 8, 9, 10, 11. They stayed cheap for 4 to 5 years before then having a great decade. Okay. So we're in an area that we've been before. Those areas don't end well. We either need the economy to start picking up a little bit and catch up to those prices, or the S&P 500 might not be the leader going forward because valuations are stubborn. They're pretty high right now. So that's what gives me a little caution, my flashing yellow light, as I'm kind of naming it. But there are things to be optimistic about as well as we enter into 2025. Number one, the Fed is on a rate reduction cycle. So they have decreased rates now a couple times. The thought is they might reduce again this month in December. So they are in a rate reduction cycle, which makes which makes things easier for the stock market. It makes borrowing costs lower for companies. It makes borrowing costs lower for individuals. Mortgages, unfortunately, are kind of staying stubbornly high, but the Fed is reducing rates, which will slowly filter its way into the economy, and the stock market likes lower rates. So that's one reason to be optimistic. The second reason to be optimistic, we'll probably see some type of tax rate extension. So at the end of 2025, if nothing is done, taxes are going up on everybody. With the new administration, we probably see some type of an extension of those tax cuts. And stock market, you can argue the merits of that amongst yourselves, but the stock market likes low taxes and deregulation. And this administration, at least the first time around, did have a low tax, low regulation type of environment, and the stock market would welcome that. So that's another reason to be optimistic. The last reason I have to be somewhat optimistic is that consumer confidence is still below average. So there's a consumer confidence score that comes out monthly. And as it works out in history over the last 50 years, when consumer confidence is high or above average, typically the stock market performs poorly going forward. And when consumer confidence is low or below average, the stock market actually does better the next 12 months. So consumer confidence today is below average. That's actually a good sign for stocks. That means that people aren't just plowing money into the markets with irrational exuberance. That means people are holding some cash back. They're being somewhat cautious. So consumer confidence being below average actually makes me a little optimistic. So some reasons to be optimistic as we enter 2025 with stocks, but it's hard to get around the fact that stocks are not cheap. They're not even average price. They are expensive today. So we're trying to hold the right types of stocks that maybe aren't too extended in price, but gives us the ability to continue to make decent returns. The areas that we are somewhat leaning to would just be down in cap size from the S&P 500. So things in that equal weight index, or mid-sized companies, or even small cap companies, they benefit most from lower rates. Companies like Apple and Amazon don't need to necessarily borrow to grow. They have plenty of cash flow. So higher rates don't affect them as much. So they have weathered the storm of high interest rates better than small and mid-sized companies. But as rates come down, that really helps those small companies. Tax cuts being extended definitely helps the small and mid-sized companies more than the large cap companies. They can perform because that affects them more. And so does deregulation. That helps those small and mid-sized companies do well. So we're trying to make sure that we're not getting too extended in cap size, which is the most expensive area of the market. Own a very diversified portfolio. Also trying to make sure our portfolios are leaning somewhat domestic with the new administration. Who knows what may come down as we enter into 2025 in regard to policy, but we want to make sure we have a very US dominated portfolio as we're entering into the new year. Fixed income as we enter the new year, I think we'll do just fine. If you look at interest rates today, although historically, when you look back over the last 100 years, interest rates might seem a little bit low. You think about a mortgage rate at 6.5 or 6 3/4. Historically, that's a really good rate. When you look at the last 100 years of getting a mortgage, something in the sixes is pretty darn good. When you look at the last decade, people are questioning, well, I'm not going to have a 6.5% mortgage. I refinanced last time and it was 3 or 3.5, right? So over the last 10 to 20 years, rates are much higher than they've been for quite some time, even though historically for the last 100 years, they might seem a little bit low. But we like fixed income still to provide decent returns and a good ballast, because with stock prices where they're at today, I would not be surprised to start to have some pullbacks at some point with the prices where we're at. As we look forward, could we have an excellent year again in 2025? Like I said earlier, it's not off the table, but it does become harder when you start with higher valuations. As we approach year end, just some things to think about, to look at with your accounts, and to make sure that that you've addressed each of these issues. Tax loss harvesting is something that we try to do for clients on an annual basis, where we go through and maybe swap some things out that might provide a tax reduction to capital gains for taxable accounts. It is hard to find losses in accounts these days. After the numbers that I gave you, definitely some things have performed better than others, but everything has performed pretty darn well in the last couple of years. So it's really hard to find any losses to do some tax loss harvesting this year. But that's one thing that we always look at. Make sure that you're funding any retirement plans by year end. Things like a 401k or a simple IRA need to be funded by year end to count for this year. Things like IRAs can be funded after the year. You have till tax time, April 15th. But retirement plans at work, 401ks type style plans need to be funded by year end. If you were going to do any donations, year end is when you have to do that by for it to count for this year. So one strategy we like to do is you can always gift a stock, rather than gifting cash. If you have an appreciated stock, you can gift that stock. The charity can sell that stock tax-free. If you were to sell that stock and transfer cash, you'd have to pay taxes. So if you're looking to do any donations, we can donate stock. You can contribute the cash to your account and we can rebuy the stock. So in a sense, you own the same position you held before, but now you restart your cost basis and you lower your taxes. The charity can sell the stock for free. All right, so donation of stock by year end, tax loss harvesting, funding your retirement plans. Obviously, if you have any way to use deductible expenses, by year end is when you have to do that. If you're buying something for a business or buying an equipment purchase by year end to get the deduction for 2024. And then last piece is making sure that you've done your required minimum distribution if you are in a case where you need to do so. Those have to be done by 12/31. So if you're 73 and over with an IRA, we have a certain percentage you need to take out based on your age. Or if you've inherited an IRA, that has certain rules too, based on when the person passed away. And you might have a required distribution on your inherited IRA that we have to do by 12/31. There's some stiff penalties that come from not doing your required minimum distributions. So that's one case that you definitely want to make sure you have taken into account by year end. So that's basically kind of the year end pieces. Again, a lot of things can be done by tax time, but those things that I just named, those have to be done by December 31st. Okay. Our policies right now, where we stand market-wise, just to give a closing thought, we're pretty neutral, stocks and bonds. Again, we like bonds. They're paying good rates of return compared to the last 20 years. They provide a good ballast, provide some predictability, and I see those having a decent year. Stocks have some reasons to be positive, but there's also some flashing yellow lights, right? So in our stance today is we're pretty neutral with your long-term anchored investment policy. So we're not necessarily overweight stocks. They're definitely not cheap. There's some reasons to be optimistic. So we're not underweight either, but we're staying pretty neutral, just a % or two more in stocks than fixed income from your standard investment policy, but pretty neutral on stock to bond. I think there's reasons to like both in this environment. And as we go through and we start to see the policies that might come in through January, there definitely will be some shifting of what's in vogue or kind of out of the favor, but we'll continue to monitor those. And as you have questions with your portfolio, make sure you're touching base. Hopefully each of us are touching base with you on a consistent basis, making those subtle tweaks, making sure we're not over our skis in the areas that are, what I would say extremely expensive, and having a good diversified portfolio. So with that, I am going to turn it back over to Ayla and see if there's any questions from today.
There are not any questions today.
Okay, well, perfect. Well, we wish you all a Merry Christmas, a Happy New Year. The next time we do a Capstone Coffee Conversation will be in early January. So thank you for joining us, and you all have a great holiday season.